Hey, my name is Tucker Kraus and welcome to my channel. In today's video, I'm going to be taking a look at Denison Mines. You probably know him by DNN, seemingly the main hype meme stock of all uranium. So that could be, definitely quite a catalyst there if it becomes that big meme stock in uranium. But, let's not rely on that. Let's actually look at the fundamentals. So smash that like button. Now, let's actually get into the fundamentals of Denison Mines and not the possibility of them being a meme stock. But that's not important. Let's get right into the video.
Alright, so as I just said, here we have Denison Mines. Ticker DML on the Toronto Stock Exchange, and ticker DNN on the New York Stock Exchange. They're currently trading at $1.63 per share with a market cap of $1.3 billion. Now, that market cap is one of the largest in the uranium space, which does mean they don't have as much room to grow as a company with, say, a $200 million market cap, but they do have the name brand, and being on the New York Stock Exchange, both of those do help make up for that larger market cap, which is harder to move, but chances are there's going to be more people moving into Denison since they're on the New York Stock Exchange. But that high market cap does mean they have a gross price per pound of $8.35. I prefer if it's like sub $1.50. This is insanely high, not a fan, but let's keep moving on and see if other things look better. Oh, wait, what's this? Before we move on, actually, it looks like only 15.6% of you guys who are watching are actually subscribed. So if you're not subscribed right now, hit that subscribe button to keep up to date with all of my videos, lots of uranium stock analysis or other commodity stock analysis. Who knows? New videos going to be coming out every single Tuesday. Alright, so here we have just the New York Stock Exchange charts because it's got the higher volume. We can see over the last 6 months they have come and exploded out of that pullback consolidation phase they were going through with SPUT and are now at, I believe this is a multi-year high right now at $1.63, as we can see here. Of course we see it. Yeah, definitely a multi-year high, though of course still a long ways they can move up when you go look at back to 2007. I just have 2 slides here from their presentation. This is just going over the timeline of their Wheeler River project, and we can see that they do expect this timeline to be delayed slightly due to some COVID troubles and delays they had to deal with. So when it says they expect to ramp up Phoenix in 2024, for my DCF, I'm going to assume 2025. But we see they expect this to last for 10 years and then have Griffin come online in 2030 and last for 7 years through to 2037. Down here, we can see their share structure. We can see 881 million shares outstanding. That's definitely on the high side, but their market cap makes up for it. Like, if the companies are more than $1 per share, usually that's good enough for me, at least for when it comes to these, very small uranium developer companies. Though still, of course, definitely on the high side. So let's get into their first project. Alright, so here we have the first part of their Wheeler River project, and that is the Phoenix deposit. I just chose to break up Phoenix and Griffin because they are very different economically. So we have Phoenix has 67.735 million pounds in the ground, which is only Denison's share. And so if you make, which is 95% of it, so that's almost the entire deposit. And there's a 3% royalty, and this is why Denison's famous. Grade of 19.1% with specific sections having a grade of up to 40%. There's initial capex of $322 million, and total capex of $425 million. So nothing insane like Fission's deposit with like $1 billion in capex, but nothing insanely low either. And they have, but this is the insanely low part, only $3.33 per pound for OPEX. That is the lowest I've looked at yet. The second lowest was Fission, and that was at about $7, and the more typical OPEX being about $30-something. So that's insane. And because, again, they expect delays, my DCF is going to assume 2025 production, so 3 years in construction, producing for 10 years. Though the main issue here, ISR come out with the freeze wall technology stuff. I don't understand it really. I know how spreadsheets work. I don't really know how that kind of stuff works. So I would have loved to get my opinion on that, but frankly I'm not entirely sure. But all I know is that it's a major risk factor because if they can't pull this off, Denison's basically done for, and there is a good possibility of them not being able to due to the fact that it's never been done before. But if you're someone who knows more about that, maybe you're like, hey, no, this actually looks really good. Or if you're someone who knows more about it, hey, maybe this is very likely to fail. Please comment down below because I would be interested to know. And they also have a 27% tax rate. Alright, so here we have the second part of the Wheeler River project, and that is the Griffin deposit. It's a similar size when you just look at Denison's 95% share at 60.61 million pounds of uranium, with once again a 3% royalty. Now, this grade at 1.7% looks low compared to 19.1%, but 1.7% is still a fairly high grade, so even in this case, that's still pretty good. Initial capex and total capex are certainly a lot higher at $623 million million and 705 million respectively, compared to 322 and 425 million respectively. The OPEX is also a little bit over triple at $11.70 per pound, but in comparison to most companies, that is still, again, very low, because most companies fall in the $30-something range. So even though Griffin looks really, really good on its own, compared to Phoenix, it's not even close, but compared to most other deposits, it's still insanely good. Once again, it is going to be constructed for 3 years and going to be producing for 6 years with the timeline unchanged. Here is their other project that has studies complete on it and assessments complete on it, and that is Waterbury. I have the full project shown as not broken up like a Wheeler River because the deposits are very similar. It has 12 million pounds in the ground, though that's only Denison's share, which is about 2/3 of it. In total, there are 18 million pounds, but once again, Denison's share is 12 million pounds. Once again, a 3% royalty. The grade's still fairly high at 1.48%, though the capex is a good bit lower. Makes sense since the deposit's quite a bit smaller at 89 million in initial capex and 129 million in total capex, and that is converted from US dollars to Canadian dollars. And the OPEX is a little bit higher once again at $13 per pound, but again, like I've said multiple times, that is still low compared to most other companies, and it's going to be constructed for 3 years and producing for 5 years. This one also uses ISR like Phoenix, though Griffin does use underground mining. So the one thing is that for Waterbury and Phoenix, it is very, very risky with that never done in the Athabasca Basin ISR, but even if those fail, Griffin using conventional underground mining would still be able to go ahead. Alright, so here we have Denison Mines. This is the total of all their different uranium deposits. So on a 100% basis, so just adding up all the deposits' total amount of uranium, there is 248 million pounds in the ground, though Denison doesn't have access to 90 million pounds of that. So fairly, Denison has 157 million pounds in the ground, which mind you is still a lot, but relative to their market cap, it still had an abysmal price per pound, even with that very, very high amount. Now going to the grade averaged across all their deposits, we see that it is very high at 4.27%, very high grade. That's the thing with Denison. And we see the other thing though is, if anything, their average grade is higher than this, since all these averages have equal weighting, whereas a lot of their smaller deposits are the ones with the lower grade, and a lot of their larger deposits are the ones with the higher grade. So if anything, this average is unfairly weighted down, and if anything, their average grade is actually even higher than this. But let's stop talking about their grade and how ridiculous it is, and let's move into the discounted free cash flows I set up for Denison. Like I've noted many times, SPUT pushed up spot price as well as the stock price, and so that will make the differences lower here due to those now higher valuations compared to greater differences when I first started doing my in-depth uranium stock analysis back at the start of August. Also, this entire time I realized I was only doing 50% OPEX inflation, not both, so this has been wrong the entire time except for my fission video and now this video. I do actually have 50% on both those this time alongside that 10% discount rate, so tomorrow I will be coming out with a video on all the stocks I've done in-depth analysis on in the uranium space with an updated price per pound, as well as an updated fair value using actually 50% capex and OPEX inflation, not just OPEX. Alright, we got that out of the way, so we can see here at current uranium spot price, Denison has 48% overvalued at current spot price. At $60 uranium, there's 17% upside from here, and at $80 uranium, there is 99% upside from here, or a 2x basically. So all in all, the company looks pretty good with their discounted free cash flow showing a double, but they have a really bad price per pound that I dislike, and there is of course that major risk if the ISR doesn't work out. So once again, comment down below what you think of the ISR. And so from there, that means we are at the end of the video. Make sure to subscribe. Again, as we saw here, please do subscribe. Thanks for watching, and I will see you next time.